Good day, everyone, and welcome back to our channel. In our last video, we explored the fascinating story of Luca Pacioli, the monk who gave the world double-entry bookkeeping, the method that turned chaotic merchant records into clear, balanced accounts. Today, in our section of the channel, Accounting Tales, we continue the journey with the birth of the balance sheet, the next step in the evolution of accounting. This is the story of how merchants transformed Pacioli's brilliant method into a tool that revealed not just transactions, but their entire financial position. A story of order rising from chaos, and of why, even today, every company on Earth follows the same simple truth. What you own must always equal what you owe. Before balance came confusion. Trade across the Mediterranean was booming. Spices, silk, wine, and wool flowed between cities like Venice, Genoa, Ragusa, and Constantinople. But the way merchants kept their books was, well, messy. Each merchant had their own system, and there was no standard method for recording transactions. A merchant might scribble, "Sent 5 chests of pepper to Giovanni. He promised to settle after the next caravan," and leave the rest to memory. A small example of a much larger problem. Debts, goods, and cash blurred into one another, often recorded inconsistently in notebooks, letters, or not at all. Errors were frequent. Fortunes were lost simply because nobody could see the full picture of their business. Then came Luca Pacioli, the monk mathematician. In 1494, he published Summa de Arithmetica, a monumental guide to everything from algebra to business. And inside its pages was a small chapter that would reshape commerce. Double-entry bookkeeping wasn't new. Venetian merchants and Florentine bankers had been using fragments of it for generations. But it lived in private ledgers, family secrets, and merchant apprenticeships. Scattered, inconsistent, unwritten. Pacioli changed that. He gathered the method, clarified it, organized it, and wrote it down for the world to see. Every transaction recorded twice, once as something given, once as something received. Not just a technique, but a way of thinking. A belief that every action has a reaction, every number has a partner, every business has a balance. By explaining the system clearly, for the first time, he turned a hidden merchant craft into a universal language of finance. And that is why history remembers him as the father of double-entry bookkeeping.
Pacioli explained that keeping 2 entries wasn't mystical, it was practical. Every transaction affects at least 2 accounts, so writing it twice forces the numbers to stay honest. If the total on one side didn't match the total on the other, you immediately knew there was a mistake. You might wonder, why not just write, "Sold a cloth for 10 ducats, earned 10 ducats income today"? The problem is that this only tracks one side, the income. It ignores what changed in your assets. Did you actually receive the 10 ducats in cash, or did the customer promise to pay later? Double entry captures both sides. The cloth leaves your inventory, and the money or receivable enters your books. Everything stays connected. Here's a simple example. A merchant sells a cloth for 10 ducats. He writes 10 ducats received, or accounts receivable, in one account, and 10 ducats earned, sales, in another. 2 sides of the same event, and the books stay in balance. Merchants quickly realized this wasn't just about catching mistakes. These 2 sides, what they owned and what they owed, gave them a complete picture of their business. Cash, goods, buildings, and debts all linked together logically for the first time. Balance stopped being an idea and became a tool, a way to see whether the business was healthy, whether profit was real, and whether the merchant could be trusted. Double entry didn't just improve bookkeeping, it made financial reality visible. By the late 1500s, Venetian and Genoese merchants had adopted double entry bookkeeping widely. But keeping 2 columns wasn't enough.
They needed proof, a way to test whether the books truly balanced. This gave rise to the trial balance, a simple list of all ledger accounts with debits and credits side by side. The name comes from the Latin word prova, meaning test or proof, and in the Italian of the time, it was often called prova dei conti, literally a test of the accounts. Merchants would add up all the debits and all the credits. If the totals matched, it was a trial run, a proof that the arithmetic was correct. But the trial balance could only tell one thing, whether the numbers added up. It said nothing about the actual health of the business, whether debts would be collected or whether inventory was accurate. It was a test of calculation, not reality. Over time, a new question emerged. If the trial balance showed totals, what if those totals were rearranged, so a merchant could see side by side what he owned and what he owed? In the 1600s, Dutch and English traders began to separate accounts this way. They called it a statement of affairs, a snapshot of their position at a specific moment in time. And that's what it was, the ancestor of the modern balance sheet. It was the natural evolution of Pacioli's system. First, record transactions reliably. Second, check them with a trial balance. Third, organize totals to reveal the financial position. The beauty of this form was its symmetry. Assets on one side, liabilities and owner's capital on the other, and always in balance. For the first time, the entire business could be seen as a system. Every transaction became part of a perfect equation. A merchant's wealth equals total resources minus total liabilities. For example, a merchant has 50 ducats in cash, goods worth 30 ducats, and owes 20 ducats to suppliers. His wealth equals 80 minus 20 equals 60 ducats. As trade expanded in the 18th and early 19th centuries, companies in the UK grew larger. Partnerships became corporations, and investors demanded proof that their money was in capable hands. The balance sheet, still handwritten, became more than a record. It became a statement of credibility, showing your assets clearly, cash, inventory, buildings, and your liabilities honestly was a way to demonstrate strength. For example, a textile company might list £30,000 in machinery, $15,000 in inventory, and $10,000 in cash against $20,000 owed to suppliers. The resulting wealth wasn't just numbers. It showed investors the company was solvent, well-managed, and could be trusted. In essence, the balance sheet became the business world's way of saying, we are stable, we can be relied upon. As transparency became vital, the profession formalized. By the late 1800s, the balance sheet structure was set. Assets first, liabilities next, equity below. Why put assets first? Partly logic, partly psychology. Investors and readers naturally look at the top of the page. Showing assets first demonstrated strength immediately. Cash, inventory, buildings, all visible proof the company had resources to back its obligations. It wasn't just practicality, it was also a subtle form of display. A company could signal, look at what we own. We are solid, stable, and capable. Liabilities and equity followed, giving context to the resources and showing how they were financed. This visual hierarchy, assets on top, debts and ownership below, made balance sheets readable, credible, and even a little impressive. And it's the order we still use today. The 19th century ushered in an era unlike any before it. Industry boomed. Railways stretched across continents, corporations emerged, and with them came shareholders, individuals or entities who own a portion of a company and have a claim on its profits, typically in the form of dividends. They needed to see their money at work. The balance sheet evolved from a private ledger into a public declaration. No longer just a tool for merchants, it became a window for the world to judge a business. Financial information now had to speak not only to owners, but to strangers, investors, banks, and governments. In those pages of ink and figures, reputations were made and sometimes destroyed. Until the mid-19th century, the trial balance remained the main control record, a simple way to check totals. But as businesses grew, it became clear that arithmetic was not enough. Stakeholders wanted meaning. So accountants began to reorganize the trial balance into two distinct perspectives: the balance sheet, showing the state of affairs, and the profit and loss account, showing performance. The balance sheet now stood on its own, not as a mere test, but as a portrait. It told a story, not of transactions, but of position, a single, powerful snapshot in time. This was the moment accounting stepped beyond bookkeeping and became analysis. As the world industrialized, the need for consistency grew. In Britain, company law began to set standards. Public companies were required to produce formal accounts, clear, comparable, and trustworthy. By the early 1900s, the balance sheet had become a universal tool. It appeared in annual reports, banks demanded it for loans, and auditors examined it line by line. What began as Pacioli's two columns now governed empires of finance. The symmetry that once guided merchants now guided nations. In the early 20th century, businesses discovered the aesthetic of accounting. The way information was presented could project stability or chaos. Clean, aligned figures in balance were a form of reassurance, like well-built architecture. Large companies began to publish annual reports not only for accuracy, but for image. A balanced report meant a balanced company. The placement of assets and liabilities became part of corporate language. To list confidently, to show liquidity, to highlight reserves, all these became the grammar of credibility. Accounting had entered the age of persuasion. Then came 1929. The Great Depression struck, and balance sheets across the world were laid bare. Many companies that seemed strong on paper collapsed overnight. It became clear that a balance sheet didn't always mean a healthy one. Valuations were inflated, debts hidden, assets overstated. Yet even through crisis, the structure endured. The balance sheet did not fail. People did. And that distinction became the reason accounting tightened its rules. Truth needed discipline.
In the decades that followed, professional bodies established formal frameworks, what we now call accounting standards. In Britain, in the United States, and eventually across the world, the format of the balance sheet was standardized. Assets remained first, liabilities and capital followed, and the equality of both sides became sacred. These weren't just numbers, they were statements of identity, continuity, and accountability. Every company, from the smallest shop to the largest multinational, shared the same structure, a silent language of trust. By the late 20th century, accounting had gone digital, but the structure, astonishingly, stayed the same. Whether written in ink or stored in silicon, the balance sheet's logic still ruled. Assets on one side, liabilities and equity on the other. Even modern accounting software mimics the old forms because they work. They reflect something deeper than arithmetic. They reflect reality itself. For every resource, there is an obligation. For every gain, a source. The symmetry endures. More than 5 centuries after Pacioli, the concept of balance has transcended accounting. It represents fairness, truth, and accountability. It reminds us that every action has a consequence, every debit a credit, every cost a benefit. The balance sheet is not just a report, it is the DNA of modern business, a universal equation that captures both what we have and who we owe. It is balance made visible. And so, the journey that began in a Florentine monastery now spans the entire world. From parchment to spreadsheet, from quill to cloud, the principle remains unchanged. The balance sheet is more than numbers on a page.
It is the story of trust, of order, of centuries of human effort to make sense of exchange. Every time you read one, you're not just seeing figures, you're seeing history. The same balance that guided merchants, monarchs, and modern corporations alike. Because in the end, accounting is not about money, it's about balance. Thanks so much for watching. If you enjoyed this deep dive into the world of balance sheets, don't forget to like, share, and subscribe. It really helps keep the numbers adding up. Until next time, keep your assets in check, your liabilities low, and your curiosity high.